Ray Dalio is a renowned American investor and hedge fund manager. He is the founder of Bridgewater Associates, one of the world's largest hedge funds. Dalio has gained widespread recognition for his accurate predictions and insightful analysis of the global economy. With his vast experience and deep understanding of market dynamics, Dalio has recently issued a dire warning to brace yourself for a devastating financial crisis. Dalio's warnings are rooted in Bridgewater Associates' approach of analyzing historical precedents to anticipate future market dynamics. By studying past financial crises and their causes, Dalio and his team aim to provide insight into the potential trajectory of the current economic climate. Before delving into Ray Dalio's prediction, it is crucial to understand the current state of the economy. The global economy has been experiencing unprecedented challenges due to various factors, including geopolitical tensions, trade disputes, and the ongoing COVID-19 pandemic. Governments and central banks have implemented extensive stimulus measures to counteract the economic downturn caused by the pandemic. Despite these efforts, there are growing concerns about the long-term sustainability of the global financial system. Ray Dalio warns that we're on the brink of a devastating financial crisis. According to him, the combination of excessive debt, wealth inequality, and political polarization has created a fragile economic environment that is susceptible to a severe market correction. Dalio believes that this next financial crisis will be worse than the 2008 recession, with far-reaching consequences for individuals, businesses, and governments worldwide. In a financial crisis, asset prices see a steep decline in value. Businesses and consumers are unable to pay their debts, and financial institutions experience liquidity shortages. A financial crisis is often associated with a panic or a bank run during which investors sell off assets or withdraw money from savings accounts because they fear the value of those assets will drop if they remain in a financial institution. To understand the gravity of the situation, it is essential to examine historical examples of financial crisis. Throughout history, numerous financial crises have caused severe economic disruptions and social turmoil. The Great Depression of the 1930s, the dot-com bubble burst in the early 2000s, and the 2008 global financial crisis are just a few notable examples. These crises resulted in massive job losses, bankruptcies, and a long-lasting impact on the global economy. By studying these past events, we can gain valuable insights into the potential consequences of a future financial crisis. Traditional monetary policies, such as interest rate adjustments, have been a go-to tool for central banks to manage economic cycles. However, with interest rates already at historic highs, there's limited room for further hikes. Dalio suggests that this constraint hampers the effectiveness of central banks in combating economic downturns, leaving them with fewer tools to navigate a crisis. Dalio underscores the rising wealth inequality as a destabilizing force in global economies. The growing disparity between the wealthy and the rest of the population can lead to increased social unrest, impacting political stability and exacerbating economic challenges. Geopolitical uncertainties, such as trade tensions between major economies, are contributing to the fragility of the global economic landscape. Dalio emphasizes that these tensions could escalate, causing disruption that have far-reaching consequences for financial markets and economies worldwide. Beyond economic factors, social and environmental pressures add to the complexity of the situation. Issues like climate change, resource scarcity, and social unrest can contribute to economic instability, creating a perfect storm that intensifies the risks associated with a looming financial crisis. The most immediate consequence of a global financial crisis is a widespread economic recession. Financial markets experience a sharp decline, businesses struggle, and unemployment rates soar. Individuals and households feel the pinch as income dwindles and consumer spending reduces, setting the stage for a prolonged economic downturn. A financial crisis often leads to a collapse of financial institutions. Banks, overwhelmed by bad loans and diminishing assets, may face insolvency. This can trigger a credit crunch, making it difficult for businesses and individuals to access loans, stifling economic growth and exacerbating the downturn. The interconnected nature of the global economy means that a financial crisis in one region can quickly reverberate across borders. International trade faces disruptions as demand wanes, supply chains break, and protectionist measures rise. This not only impacts businesses, but also leads to a slowdown in economic activity on a global scale. Currency values often take a hit during a financial crisis. Investors seeking safer assets may flee to more stable currencies, leading to depreciation in others. This, coupled with economic uncertainties, can fuel inflationary pressures, making goods and services more expensive for consumers. The value of assets, including real estate and investments, can experience a significant decline during a financial crisis. This has direct consequences of individuals and businesses, leading to wealth erosion and a prolonged recovery period for asset values. Even after the initial shock subsides, the scars of a global financial crisis can linger for an extended period. Job markets may take years to recover. Businesses may adopt cautious strategies, and individuals may become more risk-averse. The overall trajectory of economic growth may be permanently altered. Developing nations, in particular, bear a heavier burden during a global financial crisis. Reduced foreign investment, increased debt burdens, and disruptions in aid flows can hinder development efforts, perpetuating cycles of poverty and inequality. The ripple effects of a crisis can be profound, affecting various sectors and industries, and potentially leading to a prolonged recession. Ray Dalio emphasizes the importance of being prepared and proactive during a financial crisis. He advises individuals and businesses to assess their financial positions, identify potential weaknesses, and take necessary actions to mitigate risks. Dalio also encourages investors to diversify their portfolios and consider alternative assets that may perform well during economic downturns. Moreover, he stresses the significance of staying informed about market developments and adjusting strategies accordingly. By heeding Dalio's advice, individuals and businesses can navigate through uncertain times with greater resilience. While Ray Dalio's warning of devastating financial crisis is widely acknowledged, there are alternative viewpoints worth considering. Some economists argue that the extensive stimulus measures implemented by governments and central banks may help mitigate the impact of a potential crisis. They believe that the lessons learned from the past crisis have enabled policymakers to respond more effectively and prevent a catastrophic collapse. However, it is essential to remain cautious and vigilant, as the complexity of the global economy makes it difficult to predict the exact outcome of future events. In conclusion, Ray Dalio's dire warning about a devastating financial crisis serves as a wake-up call for individuals and businesses around the world. While the exact timing and severity of the crisis remain uncertain, it is crucial to be prepared and proactive. As Ray Dalio advises, staying informed, remaining adaptable, and taking decisive action are key to weathering the storm in uncertain times. Make sure to let us know your thoughts, and don't forget to like today's video. We'll see you in the next video. Thanks for watching.